Hello, listeners, and welcome back to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Rob is out this week on vacation. Enjoy your vacation, Rob. Instead, I am joined by Chase Taylor for our weekly roundup on markets and geopolitics. Chase is the founder and editor of Pinecone Macro Research, and he's also up to some interesting things as head of research of Bulwark Capital. That's happening imminently. Chase, thank you so much for coming on and pinch hitting for Rob in this weekly slot. Much appreciated. Listeners, Chase and I do some basketball talk for the last 3 to 4 minutes of the podcast, so if that's not your thing, it's at the last 3 to 4 minutes, and you can turn off if it's not interesting to you at that point. Otherwise, not a whole lot of housekeeping from me. Jacob at cognitive.investments. You can email me there if you want to talk about the podcast or about the types of research services that we sell, or if you want to talk about becoming a client and having us help you manage your assets. Those are all reasons to email me. You can also email me podcast guest suggestions or fun recipes to make for 6 to 12-month-year-old children. That's the sort of the phase I'm at right now. So otherwise, cheers. See you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. All right, Chase, the man, the mystery, the legend. The 50 people that watch this on YouTube will be able to see the lovely Pinecone lamp that you have behind you. How's it going, man?
It's good, and I'm glad you mentioned that. It's funny, these days everyone does these on video, and I've seen a couple on video where it's clear the person has no idea it's on video. Not you in your show, but I watched one the other day, and it was obvious this guy had no idea it was being recorded. It felt terrible for him.
Yeah, I usually try to let people know. Although sometimes I forget I'm on video too. I have to get the producer to make sure I'm not picking my nose or doing whatever else it is you're doing when you don't think you're on camera. Chase, Rob is out this week, so we have a little bit of a weekly gap for our sort of weekly markets review. And I thought you were actually a perfect person to slot in with this. And it also kind of dovetails with some of the research that you've been doing, and you were kind enough to send some of it over. I thought I might start. I mean, we're recording here. It's Wednesday, April 5th. This will come out Friday. The big, bank of the day is Western Alliance Bank Corporation had some results, or I guess had a first quarter report that the market didn't like very much, was down as much as 18%. Right now, it's only down 10%. We've been fairly sanguine about the quote unquote banking crisis here on the podcast so far, but I know that you're a little more concerned about what's going on. So I thought I might just tee up that softball and ask you to give us the counterfactual. Why are you actually more concerned about this, and why have we been wrong for not taking the banking crisis more seriously?
Yeah, so for me, I don't care about the banking crisis from a banking perspective per se, but I think some of the macro downstream effects are going to be a big deal, and already are, but just the same as like monetary policy, it's going to kind of work with a lag because we're talking about credit. So I think this will tighten credit more than some people expect, even though we've already had financial or tightening credit conditions for really quarters going on now. But I think that will tighten up, but more so because of not deposit flight from one bank to another, but from deposit flight to money market funds. I think that's a really big deal. I created a chart a couple weeks ago, kind of showing the rate of change of deposits, or the asset base going into money market funds. So whenever that hit that high of a level on it was like a 3-month or 6-month rate of change basis, like every time you have a recession. So it's one of those things where if everyone's taking their money out of the banking system, throwing it in money markets for whatever reason, that tends to tighten credit substantially, which obviously helps lead to significant slowdown in the economy because we are very levered to affect that credit base. So that's why I think it's a big deal. Not so much, these independent banks. Like, I don't think the regional bank thing is as big a deal as a lot of people do, but that macro downstream is a little worrisome to me.
Well, and I think you said in one of your most recent research reports that you sent over that you're still sort of in the camp of a hard landing as well, right? So you think that, and it's hard for me to argue with this, especially with how central banks are behaving. I made this argument the other day in an appearance on Likey on Spaces, which was I don't think governments and central banks are anywhere close to on the same page because the United States government, for example, is picking a trade war with arguably the most important industrial manufacturer in the entire world in China, at the same time that the Federal Reserve is let's jack up the interest rates until inflation is dead, and something there doesn't quite fit. So what is your kind of macro view of where we're going over the next 6 to 12 months? I get a sense it's probably a little darker than most people who are used to listening to this podcast are accustomed to.
Probably a lot darker. My view is that we're going to have not just a hard landing, probably a very hard landing. I think the economies are going to be in a lot of trouble, but mostly just because I think everyone has lost sight of the lagged effects of monetary policy, especially the Fed has lost sight of that. And not only have they lost sight of that, but they've kind of gone out of their way to suggest that the lags are either non-existent or much smaller or faster than they used to be. And I think they're dead wrong on that. And I think we're going to learn the hard way that those lags are still alive and well. I've kind of created this meme of the lag reaper, and I think the lag reaper really shows up in the second half of the year. A lot of times I use the analogy is it's kind of like you eat a whole pizza and your stomach doesn't hurt, so you think you're fine and eat another whole pizza. But I think that's what the Fed's doing. I think Jay Powell's like already halfway through his second pizza and his stomach's about to hurt really bad. The way I always explain it is like the way monetary policy works is essentially, I think the Fed thinks everything flows through financial conditions, so like stocks and bonds and maybe some credit conditions, but what it really is a refinancing cycle. So as people have to refinance into these new rates, that's when the impact was really felt. And because most people took out a really nice mortgage at 2-3%, that kind of dulled the early impact, I think. But that still comes down the road, and that's one of the reasons you see the banking crisis for every great, household balance sheet mortgage that someone got at 2%, there's a bank holding the bag on the other end, and SVB, loaded up on 2-3% mortgages, and turns out that's a problem whenever rates go to 5%, or mortgages go to 7%, as it were. So I just think as each, just keep having these refinancings. Obviously, the favorite whipping boy right now is commercial real estate. And I think specifically in the office space arena, like it's that really is scary to me, because all the floating rate debt that's going to have to keep getting reset at much lower, asset prices for those assets. You're going to have a lot of people walking away. And that's kind of a microcosm for everything that's floating rate debt. All of us financial markets people, we stare at, corporate bonds and stocks all day. We forget how many small businesses in the country have their financing tied to SOFR, and SOFR went from nothing to 5, and that's like a substantial headwind for some small businesses and people that don't have the luxury of selling corporate bonds at tight spreads right now. So I think a lot of those impacts, just because they haven't happened yet, doesn't mean they're not coming. It's just it does not happen overnight. And one of the main reasons I think the Fed was so wrong about thinking the lags would be shorter is because of all the excess savings and all the stimulus money that was still in the system. And a lot of people, one of the favorite doom charts out there is the kind of year over year money supply chart, which is kind of scary. But if you back away and just look at the level, we're still above trend. We're coming down fast, but we're still above trend, which shows you not just the excess savings for households, but like all the excess money still in the system. But as that starts to come down, again, with those same like refinancing lag effects, I think it's really gonna hit the economy really hard. And I mean, even this week, we're seeing a lot of the macro data are already starting to look pretty bad. The ISM this week, every single component, is in contraction. New orders being under 45. Like there's already bad data out there, but I think kind of that May, June timeframe, it gets that much worse.
Yeah, to your point, in terms of money supply, I mean, one of my favorite charts that I put out when I'm doing like a presentation to an audience is I usually throw out a chart for wealth inequality in the United States, which is at record highs going back as far as we have data. So that includes the Great Depression. It doesn't include the Civil War. I want some, PhD student out there to do a study on wealth inequality in the United States before the Civil War, so I can add that sort of feather to my data cap there. But money supply grew so much in the context of the pandemic that in the last 6 to 12 months, wealth inequality has actually started to reverse itself for the first time in literally decades. I don't think it's going to be that long lived, but I've had to rejigger all of my charts and presentations and things like that because I had that really lovely, beautiful, neat wealth inequality chart. Now I have to explain all this other stuff that's going on. To your point too, though, I mean, and it's not just the Fed. I mean, the Bank of New Zealand today, that was one of the other big things that happened with the headlines. Surprise rate rise 50 basis points instead of 25 basis points. You're getting this continuing thing where every month it's surprising inflation data, but by the second half of the year everything's going to be okay. And I guess the question that I'm leading up to is because I have to think that these central bankers, they're smart. Are they smart? Is it just as simple as that they're not smart? Like what data point do you think they need to see to understand that the trajectory that they're on maybe is not the best one for the economy, or do you just think it's sort of with missionary zeal they're going to keep attacking inflation until they get it down one way or another, whether that's with a broken economy on their hands or something else?
Yeah, I think they tend to look at the most backward-looking data there is, the coincident data, because it's kind of their scorecard. Because the public and politicians, they're not going to be looking at leading indicators; they're going to be looking at jobs and inflation. So it kind of leads them to do the same thing. But that's also why they're the author of so many busts in history and booms, because they're looking at coincident data and backward-looking, lagging data. I mean, the most lagging data you can really get is inflation and jobs. So exactly what they're staring at. So they're sort of, looking in the rearview mirror as they floor it, and that to me is very dangerous. And I think as we've seen with some of the central banks pausing, like it's funny because Australia paused and then New Zealand raised 50, that's very unique in history. That they usually are pretty close together. But the RBA was saying, hey, like we need to kind of slow down and take a hard look around because the lag effects that there are in our policy, and that's been unique in the last year globally for central banks to actually have some respect for the lag. And even like really smart macro people are saying, well, core inflation is like really high. Like how in the world could they do that? Well, but core inflation is a very lagging indicator. It just, they're trying to respect the fact that what they've already done, still hasn't hit. And you look at the Fed doing, 375 basis point hikes. 25 basis points was the standard for a reason, it was the standard because if you do more than that, you're kind of playing with fire. So if you do 75 3 times, and then 2 months later you're looking out the window and you don't have a depression, that you think, oh, we better keep going. Like no, like that's not how that works. It's not how the timing function works there. So I just think they have a temporal mismatch between kind of their mandate and reality. So and the one thing I'll give them credit for is that they kind of stop looking at housing data, which they deserve a lot of credit for that, because that's obviously, you look out the window and housing data is actually pretty bad. Prices are going down, rents are going down. But, if you look at our actual headline inflation data, like a big chunk of that is housing. So because that thing is so lagged, that's making inflation look a lot worse than it really is. But at the same time, all they really care about right now is killing inflation. I don't think they care about the collateral damage at this point. So as long as they get that job done, I think they're going to be fine. And they realize whatever, we'll cut later to kind of get the economy going again. So I think part of it is just they're going to do whatever they got to do. Like really is kind of a missionary mandate to go kill inflation, no matter what they destroy in the process. But at the end of the day, they're looking backwards, where all the leading indicators are, I mean, you get just about pick one. It's brutal, and then you look at the coincidence data, and it's still fine. But that's how these cycles work. That's how the data works. That's how it typically works every time. And we're getting to the point where the last 2 legs in the stool, they're going to go down. Will be earnings, and then after that will be jobs. And so I think we're within definitely within 6 months of jobs going like deeply negative, maybe within even 3 or 4 months.
Is there any reprieve? Is there any silver lining? Is there any plausible scenario for you that makes you think that things could be better than what you're suggesting right now?
Not really, because at the end of the day, if things are better than I think, they're just going to keep raising rates. So now, unless you do get the immaculate disinflation, where inflation just starts going down severely without them, doing more. But I think even there, the timing is it's just going to be off for that to be enough of a possibility to happen. Now, year over year, I think you can see that just because of the comps, that inflation can go down significantly. I've been for a year now, probably have called for under 3% by the end of 2023. And I still think that can definitely happen. And I think they would be very happy with that. I just think it's going to happen in part because of a recession, at some point later in the year.
Thank you for making my job easy. Immaculate Disinflation, perfect title for the podcast, so I don't have to rack my brain for pithy titles sort of after the fact. I thought we might pivot from there because I've wanted to talk to you and catch up with you for a while. First of all, I want to hear your hot takes on the Cleveland Cavaliers. But before we get there, I wanted to pick your brain about commodities because you're one of the voices out there that I respect the most when it comes to commodities, and I've been wrestling with commodities quite a bit. And I'm getting more and more uncomfortable with the idea of a commodity super cycle in general and how that narrative is taking off. And specifically I think you're beginning to see it a little bit with what's happened with oil in just the last week or 2 weeks, where you've got these perma bulls and these perma bears, and everybody's out there talking their book, and OPEC saying one thing one week and then another thing the next week. There's just sort of all this stuff. And, we start the week with surprise Saudi, cut along with Iraq and Algeria and all these other countries. We go up 7%, and then we start to sort of hang out in the middle here. Like I'm kind of lost. I guess I've lost the narrative thread for that broader commodity super cycle argument, and I thought oil would be an interesting way to talk about it. So do you want to pick it up from the macro super cycle question, or do you want to talk about oil first, and then we can back into the super cycle question? Dealer's choice.
Let's start with oil, because I want to say I saw a tweet of yours, and it was like, so far, you're really the only person I've seen that agrees with me, and that is, first of all, I've been in a really hardcore oil bull since 2018, and I still am from a kind of a medium-term perspective. But I think, obviously, my macro outlook suggests I think there's going to be some problems in the near term. But all the oil bulls just cheered OPEC doing this cut, and to me, like, that is absolutely a sign of weakness. That's what you do if you A, see softness already, and B, see, demand having problems as we move forward, which I think is absolutely right. I think they're smart to cut because I think demand is going to be a problem, but this getting framed as some sort of like strength, I just don't understand that. One of the strongest kind of pillars in the entire bull thesis for oil was the fact that spare capacity was getting really tight. Well, now all of a sudden spare capacity is starting to pile up. So I think you're kind of losing one of the main legs of that thesis. Now, maybe we have such strong demand that they have to go right back to pumping, max out next year or something. That's very possible. But at the moment, I just don't see that as bullish. Obviously, the price likes it because there's less oil hitting the market. Like, obviously, that makes perfect sense. I'm not saying oil should have gone down on the news. But what I do think is in the next few months, especially if we hit a recession in the U.S. and that really dense demand, then I just struggle to see this $150, $200 nonsense that I'm always seeing, imminent from some of those oil bulls on Twitter. But I expect oil to be flat to down probably for the rest of the year.
I was especially surprised by the Saudi move because I feel like lower prices were taking out their competitors to a certain extent. I say this often. If you go back to the week or two before COVID, the biggest geopolitical macro market story that everybody was talking about was the Saudi-Russia oil price war. If we hadn't had the pandemic, that would have been the biggest story of 2020, and it would have been a really interesting sort of saga. But I sort of always think of Saudi Arabia as still in that mode. Saudi Arabia can survive lower oil prices much more easily than, say, a Russia or some of these other OPEC countries can, just because of how easy it is for them to get oil out of the ground. Now, Mohammed bin Salman has all these grand plans and how he's going to transform the country into
pay for Messi with $50 oil.
I saw that. I guess you need the $80 barrel oil because you need Messi to come over. What is Messi thinking, by the way? I need to get somebody why does he want to go to Saudi Arabia? I guess so, but I mean, it must be a lot of money anyway. But one of the other main competitors for the Saudis was the American shale producer, and the American shale producers were on the ropes. They were out a month ago saying, "Hey, we might be at peak shale. Hey, we might be importing from the Saudis again in a couple of years. Things are looking really bad." And by propping up prices at this sort of $80, $90 level, I mean, isn't Saudi Arabia just kind of helping out their competitors? Maybe they don't care. Maybe they're just trying to make a bunch of money right now so they can pivot to, messy land and whatever else. How do you read that?
Yeah, I'm kind of split. So part of me definitely agrees with everything you just said, but part of me, it has become clear that they have gained confidence that they've already largely dealt with shale, and that shale is sort of starting a bit of a decline with or without their actions. So I think they're confident this doesn't mess with their market share moving forward. I'm not sure that's correct. I mean, to your point, we were seeing, rig counts kind of rolling over. We were seeing, other than the Permian, a lot of struggles in the shale space. So I think you're definitely not wrong there. But it's clear to me they're really confident, but they are also, spending billions of dollars on poaching soccer players and golfers and building, crazy tourist trap cities. And so I think MBS is having, a grand old time with his money and doesn't really want it to stop flowing. But, to me, you could have taken out a lot of your competitors in a much more significant way, especially Saudi, or especially Russia, to your point, and the pressure that would have put on Russia geopolitically. I keep seeing so many people that are getting fed up with that war from the Western perspective, and obviously the West is getting tired. But when you just look at the financial situation in Russia, if you hold on a little bit longer, I mean, I don't know where they get the money. Their deficit is just blowing out. They're just ripping through their rainy day money and things like that. So unless China's willing to just fund this thing, I think they were going to be in a really bad place, which makes this, from a geopolitical standpoint, really interesting. It's almost wait a second, are the Saudis kind of throwing Russia a lifeline more than anything with this cut? And I'm not suggesting that. I don't know, but it makes it a little interesting, I guess.
Well, I'm glad you raised that because, first of all, Michael Pettis, who I've been learning more and more about and reading more and more about, he had an interesting argument where he was actually talking about, previously when Saudi Arabia was trying to raise oil prices, it would have gone into boondoggles like Messi and these tourist trap cities and things like that. And he said, if you give Mohammed bin Salman the benefit of the doubt, if Saudi Arabia is actually going to invest in productive industries and the tech economy and all these other productive things, then that could actually be a net positive for the global economy. To your point, I'm not sure how, luring Messi with a $350 million, whatever it is, contract to come over is evidence that that's actually what happened. It seems more like wishful thinking. But I guess there is, in the West, there's this desire to think that Mohammed bin Salman is real about all these things. But I don't think it's a lifeline for Russia at all, because I think the other thing that has gone sort of underreported about this was that China was not happy about this. It was a week ago that we were talking about China and Aramco and all this new cooperation between China and Saudi Arabia. China had no advance notice of this. Chinese refineries were looking for places that they could actually import oil from because they were worried they wouldn't have access to their normal supplies. Russia supplanted Saudi Arabia as China's top import source for crude over the last couple of months. So I think in some ways, Saudi Arabia was sticking it to both of them, which is interesting. We think more about Saudi Arabia giving the middle finger to the United States, but I guess they're also sort of saying to China, hey, if you're going to go import from Russia, we're not going to make this easy for you. And that's a really interesting dynamic too, because I don't think, and I could be wrong about this, we've had plenty of people on the podcast who come on and tell me I'm wrong about this. I don't think China wants to bankroll the war. I think China just likes really cheap oil. And if they can get it for $8 a barrel cheaper from Russia that can't sell anywhere else because of the politics of everything, that's what they'll do. And they're not going to care about the rest of it. But I have a suspicion that that's what's going on there with Saudi Arabia. And I don't know how that's going to go. That could blow up in your face very easily, I think.
Yeah, absolutely. And I think you're right. At the end of the day, China just wants cheap oil. Saudis just want expensive oil. Russia just wants to be able to sell their oil, hopefully somewhere in the same zip code as actual going prices. But it is super interesting with what, and obviously some people think this is just a big MBS Joe Biden thing, and the fact that we weren't going to refill the SPR made them mad, so they were going to teach us a lesson. So there's definitely political possibilities in all of it, and that's fun for us to talk about. But probably at the end of the day, they'd probably just have a bogey at $90 and it wasn't there, so they just decided to do something about it. It's probably something that simple, even though it's more fun to talk about it from the chessboard standpoint.
Well, let's overturn the chessboard, because the other part of this, because you're also one of the only, I wish that I had as much conviction as you did about YPF, because so YPF is this state-owned Argentine energy company, which I had been writing about and thinking about for years, never developed the testicular fortitude to actually say, okay, we should go for this. This looks good honestly, because Argentina. I don't really need to say much more than that. It just seemed like a total dumpster fire. But you had a recent research piece that you sent to me about the possibilities in Argentine shale and YPF and some of these other Argentine companies. And if you look at the charts, they've done extremely well since you put out that report. So help us understand. So, we've got all the MBS and Biden and, pawns pushing all over the place. But another thing that I think is sort of going under the radar here is Argentina is this rising shale superpower. Guyana has a fairy tale discovery, according to ExxonMobil, and is pumping. The United States is even starting, Chevron got 100,000 barrels out of Venezuela last month. That's not a ton. It's also not nothing. Is Venezuela about to wake up? There's some very interesting things happening in general in Western Hemisphere outside of the United States. So why don't you start with Argentina and take that wherever you want to go?
Yes, I find it super interesting. And whenever I first started digging into it, it was basically from okay, I see that Argentine oil production is moving higher. That's interesting. Let's figure it out. And I started, in the back of my mind, biased as this is Argentina. I probably don't want anything to do with this. They're going to find a way to mess this up. But doing the research, I realized okay, they're serious about it. They're making policy changes. The government really was doing everything they could to make this work. When it comes to the actual, geology, it is a wonderful basin that has a lot of recoverable oil. It's just a matter of getting it. And even more so, it's a matter of the takeaway capacity of pipelines to get it out. They're talking about, doing LNG exports of the gas. There's significant gas there. They've already built a pipeline that goes from that desert down into Buenos Aires. So they're making it all work. They're building pipelines. They're in very serious talks to do the LNG export terminal. Their production is just substantially rising. So this thing's real. It kind of surprises me. And what I find most interesting is kind of the feedback loop between the success of the country and the success of their oil there. I mean, if they can get this going to where they can stop importing so much, especially natural gas, you're talking, billions and billions of dollars worth of gas imports. And if they can go from a net importer to exporter, all of a sudden their giant, dollar problems go away. Their trade deficit goes from horrific to pretty decent. Things like that. It really helps their currency stabilize, especially if they stop, printing too much of it at some point. And all that macro, all of a sudden tailwinds from energy kind of help energy, because one of the reasons a lot of big capital providers in the energy space don't want to deal with it is because they're afraid of the currency and the politics. So it at least holds the possibility of becoming a self-reinforcing loop of goodness for them, for energy, and just for the country as a whole. So very interesting. Like you say, it's already done really well. So I've been actually trimming. Even this morning I was trimming some of the positions. I think I held 6 different equities in Argentina, finally taking some off because it has done well, and now I'm getting a little nervous on oil because I think global growth and US growth are about to kind of have some issues. But it's one of those where anyone that hasn't done the work on it, I would definitely suggest go take a hard look at oil in Argentina and shale production, natural gas, all of it. And then, especially if you think I'm right, that we're about to have the lag reaper show up in the U.S. economy, it's going to get cheap again, and you'll be able to to kind of go grab it on sale at some point. So I think it's worth the work for sure. And to your point, like Guyana, I mean, just what they're doing for their size of GDP of that country. I mean, it's unreal, the money they are making and are going to continue to make. It makes you want to go there and start some sort of business, but I'm sure everyone's thinking the same thing. And the last thing they need is me there, that's for sure. But it is really interesting. And even Venezuela, from a geopolitical standpoint, I can't think of a better like time and place for the U.S. to like get someone back on board or in some way if they can. Obviously, we tried the opposition and that did not work very well at all. And we've kind of made at least a minimal inroads with Maduro. But I think geopolitically it makes a lot of sense for the U.S. and Venezuela to find a way to come to terms and do some business together again. I don't know if it'll happen, but it definitely makes sense.
Yeah, maybe we need to send Steven Seagal back down there to open up negotiations.
Clearly the answer.
But, well, help me square that with, because you said medium term, you're sort of more bullish the price of oil. And I sort of see that argument in the sense that we've had underinvestment for a period of years, and that's going to lead to a lack of supply in the market. But that's now been the narrative for, about 12, 18 months? Like, I think there has been some more investment now in the space, and I'm sure higher prices, we hit those really high prices we had last year and, all this news this year. I feel like we're starting to get more investment, more interest in oil. But when you actually look at what's out there, I mean, there's a lot of supply if you just decide to go take it. There's a reason that like the oil market has cartels like OPEC, because if everybody just produced as much as they possibly could, oil would be very, very cheap. There's actually probably too much of it in terms of demand if you didn't actually control production in some way. So why is it as simple as that underinvestment is still the case and ESG has really taken the wings out of oil? So when we get back, at a 3-5 year time horizon, there are going to be these gaps with India and China and Indonesia and all these other countries rising, or is there something else going on there?
Yeah, I mean, you basically just made a whole argument for me. So okay. I think it is as simple as the investments. And to your point, like the investment has risen some, but if you just looked at it like on a long term kind of chart for capex, it still is nowhere near where it needs to be for us to keep growing production the way we need to. I think people don't realize how much of a treadmill oil is, and if you just stopped investing in it, you'd lose like 7% of production a year. I mean, it just falls off a cliff if you're not willing to put a bunch of money in the ground. And one of the big parts of my thesis though was what was that, like ESG, the fact that you can't get capital. And I mean, they've made their own capital in the last couple of years because oil's done so well and they haven't invested. So now they're all sitting on money. Granted, they're giving a lot of it back to shareholders, but I think they at least have enough, money that they can fund for themselves to invest. So you should see an investment cycle that picks up. One of the reasons it's hard for me to like get really bearish on oil though is they still haven't really invested that much, and it's really hard to kill an oil cycle because typically what you have is way too much investment. You just have everyone go nuts to try and capture that $150 or whatever it is. And until we get that, I don't think you can have a proper bear market in oil other than just macro induced from the demand side. And also to your point, you look at India's going to be Indonesia, like a lot of Southeast Asia, is going to be the driver moving forward. So unless they all go, significant EV penetration into those emerging markets, especially, I think you're going to have demand keep going higher, and it's just not easy to meet that. And you were talking about like, you just kind of turn it on, but OPEC at one point was kind of all out. Like they were doing everything they could, and we reached a point where they were doing everything they could, and you're looking around going, like where's like the incremental barrel going to come from? And then you had China completely shut down, and that was sort of the relief valve. That obviously that relief valve is closed now. So between that and OPEC cutting, without a recession and global slowdown, I think you would see a significant price spike right now. But because you're going to slow demand down with slow growth, you probably won't. But let's say a year from now, we've kind of dealt with a recession in most of the world and everyone's stimulating again instead of raising, then I think you're right on the cusp of having triple digit oil and in a struggle to keep up with demand, like all over. Unless, again, like things like EVs just start taking over enough market share to at least flatline demand, which is not impossible.
Well, I don't know where the commodities come from that. I think biofuels is the more interesting one. If you look at places like, Indonesia's saying, okay, more palm oil in our fuel. In Europe, different places, it's ethanol, it's renewable diesel. Like, I think the biofuels thing is very operative there. But then that starts to pressure on food prices, which if you look at the inflation data everywhere else, like the highest right now, like energy is relatively down year on year. To your point, housing data sort of mixed. It's those food prices that are really stubborn and that are really stuck in place in some ways.
I think we all have a crazy aunt on Facebook really mad about egg prices.
I don't have a crazy aunt on Facebook about egg prices, but I think egg prices could get a lot worse too. But that I think allows us to back out and zoom into this commodity super cycle narrative, because it, you sort of raised it. It goes to the EV question. Like, if we're going to scale up, for example, EV production, well, then we need a lot of cobalt and a lot of lithium and a lot of nickel and a lot of all these other things that we don't have enough of. And I guess that's the argument for the commodity super cycle. But I'm kind of just struggling to see it, because if China is having all these problems, like they've got their real estate crisis, they're in a trade war that's going to depress their growth in some ways. The Chinese consumer is still not consuming, despite everything that Xi Jinping has done to try and encourage spending, go out there, do stuff, Chinese citizens. They're still, I think I forget if it was the PBOC or somebody came out and said, they're still sort of sitting on their hands. So if you're not going to get this China returning to help support global growth, are you really going to see commodities in general just boom because everybody's building EVs? I don't know, something doesn't ring true there for me. So do you have a sort of broader view on where commodities are going in the next couple of years? I mean, I can make reasoned arguments for some of them, like copper makes some sense to me. But when you start to get into the lithium land and all these other things, I start to glaze over and I start to get a little more skeptical.
I mean, to me, at the end of the day, what you need for a commodity super cycle is a really weak dollar. So I think we could talk about supply and demand for all of them, and obviously that matters. But I think if you're really going to have a proper super cycle, the dollar would have to be in a secular decline. Again, to me, not impossible, but I'm kind of like you, though. I prefer to look at them all on their own merits instead of just putting them all together. So like copper, I've definitely done a deep dive on copper supply and demand, and to me, it seems fine for the next year or two, but then it probably is going to be a significant problem. So that's one that you don't have to love now, but do you want to be in it over the next decade? Absolutely. And I think it's going to be the same for a lot of the battery minerals and everything. But on those, I will say, you could go back 5 years and run all of the, like, well, if we're going to have X EVs, we're going to need Y cobalt, and we just can't get it. And then here we are, like 5 years later, and the adoption curve of EVs is still really strong. And we didn't break the world with running out of cobalt or lithium or any of it. So I think it's such an easy thing to look at those and do the extrapolations and just be like, well, we don't have that much of, mineral Y. But we all said the same thing on oil, 100 years ago, 50 years ago, 20 years ago. Now people are saying it about oil. And turns out we're like really good at going and getting stuff that fetches a lot of money. So I think we'll probably figure it out on all that stuff, even though when you just do the analysis, it is hard to figure out where it comes from. One of the things I'm about to do a deep dive on is EVs, because it's actually surprised me with how strong the penetration has remained and the adoption curve has remained. I kind of thought it would start flatlining a little bit more than it has. So I'm taking it more serious all of a sudden as a threat to fossil fuels. Something I definitely made fun of, 3 or 4 years ago. Is like, that's not going to be a thing. And maybe it still won't be, because when people go to trade it in or go buy a new battery, they realize like it's not as fun as they thought it would be. But so I'm not sure on those. I don't really trade cobalt or lithium or anything like that. Obviously I do copper, but
well, you can't really trade cobalt or lithium unless you're willing to go risk your life in the Democratic Republic of Congo and make some deals with some dudes down there. Like, I don't know how
you can trade lithium, but
right.
not with any liquidity. So if you have size, you're not going to want to trade lithium, but it actually trades. And I think that is something that 10 years from now there will probably be a liquid futures contract for, but probably not cobalt. But at the same time, when it comes to those metals, battery chemistry is always changing, and what they use for anodes and different parts of it, is always changing. So maybe we're all looking at the wrong things to begin with, and solid state batteries will take over, or something completely different, 10 years from now. But for now, like if you go look at the charts of all those things, most of them are getting beat up, which most people did not predict. Everyone just thought, oh, well, it's going parabolic and it's going to keep doing that because we don't have enough. But no, it didn't work that way. Never does.
Yeah, you're right about EV adoption, though. I mean, I'm here in Louisiana, and at the Superdome where the Saints play, Louisiana, a fairly oil-rich, natural gas-rich, hydrocarbons, fossil fuels are a big part of the local economy here. But you can park close to the Superdome because they're putting in the charging stations there. You can get if you're at the airport, like they reserve the first floor all for EVs, and they're all plugged in, and it's all Teslas and everything else. And it's funny, I consider myself fairly green when it comes to policies. Like, I think we should save the planet. It would be nice if my children and their children could, enjoy things like fresh air and clean water and things like that. Like, I'm on board. But I'm skeptical of EVs. I don't know if this is just because I've gotten so cynical from being in geopolitics and markets now for as long as I have been. But it doesn't make sense to me, and I don't even really kind of trust it. Like, I'm still like, I don't think that, the guy driving his car with his fossil fuels is the problem, but I'm off there because I think you're right. Like, we are getting this mass adoption, whether it makes sense or not,
Yeah, I've definitely been in the skeptic category and even the making fun of category. And in general, I don't really understand renewable energy almost at all, other than like I think on a very small scale, wind and solar can make sense, but and obviously I think nuclear is great. I think hydro makes sense as long as you're not, doing too much ecological damage. But wind and solar on large scale, that kind of stuff never made sense to me. EVs never really made much sense to me. I think hybrids made sense. But we decided that was good enough for whatever reason. But here, yeah, it's like in the last 6 months, I've kind of been reading a little bit and been surprised. It's just really continues to grow. To your point, like I spent a decade in California, and they're everywhere. If you're in the Bay Area, it feels like half of the people there have an EV. But then you get out in the heartland and it's like, oh, they're all gone. But now we just drove all the way across America making our move, and they're cropping up in more and more places. Obviously DC is a little bit, kind of, it may as well be the West Coast, or plenty of coastal elites there. So but when I worked there, the parking garage we had, you got primo parking if you had one, and it was a significant amount of EVs parked there.
Yeah, I mean, this is also just in the realm of anecdotes, so take it for what it's worth. But
Sure.
when I go rent cars, if I fly to some place and I have to drive somewhere else and I'm renting a car, like, it's now actually cheaper to rent the Tesla or to rent the new EV, like the Hertzes and the Enterprises. They've slashed the prices on renting those. So you can get a super nice brand new Tesla, or you can get, a shitty 2017 Nissan Altima. I guess that's one way that they're trying to get people to upkeep there. But again, that feels like something's wrong to me. Like, or how are these rental car companies Hertz went bankrupt, didn't it? And suddenly they have Teslas on the front line that when I'm getting there, they're trying to get me to take the keys to the Tesla. Like, something does not quite line up for me with what's going on there.
Yeah, that's weird and interesting. I didn't know that. I've never even seen the option when I was renting a car. That's interesting. I'm about to try it one of these times.
Yeah, I have not had the bravery, because usually when I'm flying, I'm usually like driving someplace in rural America afterwards if I have to rent a car, and I'm not going to get a Tesla and then drive 3 hours into the middle of North Dakota. Like, that seems like a recipe for disaster. What should we close out on here, Chase, before we get to some basketball talk? I know that you were also looking at cocoa. I don't know if that's still interesting to you. Is there anything else you want to riff about geopolitical wise or market wise before we delve into some casual basketball chatter?
We didn't talk about gas much, and I think it's interesting because we talked about it the last two times I was on with you. The first time I was pounding the table and bullish. The second time I was saying, you know what, now I'm selling. Like, I think it's gotten a little crazy. And that was, when it reached $10, I was like, okay, well, that's actually probably a fair price. But now, and what's interesting is all the energy, zealots we've been referring to, a lot of them love oil and hate nat gas now. Well, the time to hate it's not at $2. Like I think summer is the new winter when it comes to gas, especially in the U.S. where so much gas demand is for power burn and not just for heating. Obviously, we continue to warm, and we're seeing really ugly temperatures crop up in places like India, China, South America. So I think we're in store for another hot summer, and I think that will drive a lot of power demand. And that goes to the summer is the new winter for gas. And I think you sit it out in the winters, especially if you think they're going to be mild, which honestly was the funny thing about gas collapsing this winter. It was kind of a consensus take that, hey, it's going to probably be really mild. I pay 2 different weather firms to stay up with weather, and they were both like, yeah, we think it's going to be mild. So I was like, okay, well, that's enough for me. I'm going to get out of the way of this thing. But then you go from $10 back to $2. So a lot of people weren't ready for that, obviously. But at $2, you're going to start seeing production fall off. And then as soon as you get, now LNG exports are all the way back up to new all-time highs after falling 20% thanks to Freeport. So I'm constructive on gas again. I think you can be right back up over 5, 6, 7, even maybe all the way back to 10 by the end of the summer. I don't think that's impossible.
By the end of the summer, yeah. I don't know if you saw the White House and the EU put out a joint statement about how the U.S. is committing to another, I forget what the exact number was, but some astronomical level of LNG exports to Europe as the war keeps going. Mm-hmm. And I'm glad you brought up gas because last time you were on, I was also in September of last year, I was saying, I don't believe this natural gas price spike thing. I don't think it's going to happen. And I've gotten my fair share of things wrong. But that one, at least I got right. But I'm sort of in a similar position to you right now. I wouldn't even go summer as the new winter. Winter is still a problem. Even if we have, generally warmer winters, you can still have super cold winters. Most listeners, if you're not, I know that my listeners in Minnesota and North Dakota and some places, north in the Great Plains right now, they had an epic blizzard this week, absolutely freezing temperatures. Farmers in the United States haven't been able to get out to start planting, some of their crops for the next season going forward. Like, yes, there might be sort of these unprecedentedly warm winters happening in Europe and things like that, but we've also had a triple dip La Nina, and that is also finally going away. So we're going to go back into El Nino land, and things are going to be a little bit different. So I think last year, markets and media and everybody and their mother was talking way too much about the natural gas crisis in Europe. And I feel like this year, the conversation it's gotten way too blasé. And maybe you're right about summer, but the thing I'm really worried about is winter. Like, what if you actually get a cold winter? Just because on average we're warming and we're getting warmer winters doesn't mean that you can't have a really cold one in there. And if you look at all the data, neither you or I are weathermen, but you would kind of think that we're probably due for a colder winter, especially with the luck that we had this year and with the Russia-Ukraine war still going on and everything that we've just talked about. U.S. is going to continue to export. I'm with you. Natural gas, when it's this low and everybody is talking down to it, is probably the right time to look at it as an opportunity.
Yeah, absolutely. And there I'm talking more like U.S. based and Henry Hub, but I think same thing for Europe. And to your point, like, with or without global warming, you can have a winter where the polar vortex just keeps, getting penetrated and pushing down to lower latitudes, and that's all it takes. So, just one active polar vortex year is enough to just absolutely demolish, storage. So, and in Europe, with the flow of Russian gas being what it is, that can still be a problem. They got incredibly fortunate this year. It's actually really scary to think about what inflation would be in Europe right now if gas had stayed, even reasonably high. Obviously, it wasn't going to stay where it spiked to, because that was just completely unsustainable. But it's pretty wild to think what they would be dealing with right now. They're very fortunate.
Yeah, but it's not over. The war, like Macron is in China trying to convince Xi to do something. Like, you're right that Russia's economy looks terrible, but Russia's economies look terrible forever. I don't see that either Ukraine or Russia are willing to give it up here. And until they're willing to give it up, like all of these macro dynamics that you're talking about, like the LNG supply is just not coming online. So maybe the Europeans will outpay everyone for these LNG exports that are out there, but that's going to mean higher prices for the US consumer. It's going to mean countries like Pakistan are going to say, hey, like, we built all these LNG facilities, but we can't actually afford the LNG. So we're just going to go burn coal. And that's literally what the Pakistani government's saying right now,
The problem with that is you end up with your own problems with coal. Going back to lack of investment that has been significant in coal. So even that may not be a safe haven for folks that like Pakistan that don't want to pay for LNG. Although now with LNG where it is, like, to me, it should be just kind of like price dependent. Like, sure, don't buy it when it gets expensive, but some countries are now starting to talk about strategic LNG reserves and things. Like, maybe that makes sense, even though, it doesn't store as well as oil, obviously. But go buy it when it is cheap. Like right now seems like a good time to go, buy some LNG and put it in a sphere for a little while. But then, yeah, don't buy it when it gets expensive. I think the world needs people like Japan to go, make this nuclear, renaissance as fast as possible, because they're such a enormous LNG importer. And China's imports of LNG are going to be really fun to watch as, their economy kind of comes back. Because they kind of took the year off, which really helped gas prices as well. So if they don't take the next year off from LNG imports, what is that going to do to LNG prices as well?
Yeah, the more and more I think about energy, the more and more nuclear seems like the answer. Now, it's probably been the answer for decades. So just because it is the answer doesn't mean that it's actually going to get adoption. Like, there's no company like Tesla out there that's making nuclear sexy. I think most people have deep reservations about nuclear because of 3 Mile or because they saw Chernobyl on HBO or whatever else. But if you're just looking at sort of cost and benefit and what's good for the environment, and nuclear does seem to be the clear answer, but politics sort of gets in the way there.
I will say, I think some of the small modular reactor type companies and the ones making some unique fuels, they kind of make it sexy. People just don't know about them yet.
Well, now you do if you're listening to this podcast. Chase, cheer me up about basketball. I went to the Pelicans game last night and watched the Pelicans get their asses kicked by the Kings. Shout out to Kings fans out there. Wow. Sabonis is so much fun in person, and I'm so glad you guys have it. Like, they beat us, and they weren't even working hard. It was kind of embarrassing.
So speaking of, I spent basically, 7 years in Sacramento. So we used to go to Kings games back in the old terrible Sleep Train Arena. Then they moved downtown, and they're still bad, but I'm excited to see them good again for the first time since, oh man, I don't even want to talk about how old that was last time they were good, but it's fun to watch. That if people remember back, their fans were incredible back when they were good, 20 years ago, whatever it was. So I think them being kind of back on the stage is going to be a lot of fun.
Well, and they're a really fun team in the same way that they were fun, 20 years ago with Weber and Stojakovic and it was beautiful basketball. It was all passing, and it was all movement, and it was a joy to watch. Like last night watching them, it was a joy to watch. Sabonis, not only is he a great passer, and he was like running the break, and he was working hard on defense. Like I go to a fair number of Pelicans games. It's very rare to see somebody who's actually trying on defense every play. Sabonis was out there, Valanciunas, who is the Pelican center, he's got at least a couple inches and quite a couple pounds on Sabonis. And Sabonis was like every single play, he was like in his jersey. It was really impressive. But tell the listeners why. Well, are you optimistic about the Cavaliers? You've got some things sort of setting up nicely for you, but I guess you also have, some buzzsaws like Giannis and Tatum waiting for you in the Eastern Conference. So where are you with the Cavaliers right now? I like that team, but you've definitely got some challenges coming. Yes.
So, obviously I'm really excited to make the playoffs without LeBron for the first time since I was also very young, even younger than when the Kings are good. But that actually Philly is kind of who worries me. I just think we don't match up great against them. We kind of struggle with them. I actually think we could beat the Bucks. Probably not Boston. I would think that'd be a great series actually. But the reason I'm most excited, obviously everyone knows how great Donovan is and all the points he's been scoring, but Evan Mobley is just really coming into his own offensively lately. He's already a great defender as a young guy, but he's just gotten a lot more aggressive and assertive on offense. So they look to get him the ball, which creates a lot of space for all of our other scores. So I'm excited about them. I think they have a really good team. I think they're built and constructed well. Like we have a couple guys that don't care that they don't score, that let's go play defense and rebound, and they're fine to do that. And then we have Donovan Mitchell, who goes for 40 almost every night. So I think it's kind of a unique mix. And they play defense, which, again, like you were talking about, kind of rare in the NBA, but that's a big part of their identity is to play defense and rebound and win 50-50 balls, things like that, which I think come playoff time, all those little extra possessions all of a sudden get magnified. They matter a lot. So their defensive efficiency could make them go on a longer run than people expect, but I don't expect to go all the way to the finals this year. I think the East is a little too tough, and Philly is the one that worries me the most.
Any finals predictions you want to hazard? Don't worry, we won't hold you to them.
Oh, man. You know what? Just for fun, we'll keep the theme going, and I'll pick the Kings to just blow everyone's mind and go from being total nobodies to the finals. And I'll go Philly. I don't know what it is about Philly. I just think they're a little tougher than people think. Although, speaking of defense, it's hard to pick a James Harden team to go to the finals, but because he plays none. But
I assume that he will show his real colors. So we're talking Kings, Sixers, and you think it's Kings take it or Sixers take it?
Let's go Sixers in 6. Why not?
Sixers in 6. You heard it here first. Sacramento
not
Kings.
Not happen, by the way, folks.
Well, hey, my prediction was Pelicans Bucks, so we'll see where I'm at right now. So Chase, we'll have you back on soon. Thanks so much for making the time, man.
All right, appreciate it.
Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.